Hi, I'm Jonathan Bays, and this is our March investment market outlook. Perhaps a quick recap from me on what was a volatile month in February. Really poor start to markets in the first week or two. Share markets in the United States falling 12 or 13% in pretty short term, and in Australia markets were off about 8 or 9%. Fortunately, they recovered and bounced well. The economy in the United States, and in fact globally, we've talked about on many an occasion, is doing really well at the moment. But at the same time too, the sell-off certainly scared me, and I'm sure scared a few people, and we need to pay attention to why it occurred, and I think it will inform our opinion going forward over the next couple of months, and perhaps a little bit more caution into portfolios on account of the reasons for the sell-off. Perhaps more relevantly for portfolios, in February we had a corporate reporting season in Australia. It was reasonably good for our portfolios. SEEK was a real standout. They upgraded guidance. Downer reaffirmed their upgraded guidance. We saw reason to take some profit in Woolworths after what was an okay result, but the stock has performed well for us in the last 12 months and been a good outperformer, but we now think it's reasonably fully valued. This month we've got Matt Cassidy in New York, who's talking to Ed Fitzpatrick from JP Morgan.
Matthew Cassidy, we're sitting here in New York in the offices of JP Morgan, and I'd like to introduce Ed Fitzpatrick, Executive Director and Portfolio Manager for JP Morgan. Welcome, Ed.
Yeah, thank you for having me.
We'd love to get a feel for JP Morgan's assessment of the US economy at the current point in time.
Sure. So we remain very positive on the economic outlook. There's been strong momentum heading into 2018 on the back of renewed confidence from the household as well as the business community. We expect inflation to be modestly rising, consistent with the Fed's objective. Additionally, we see the breadth of the U.S. economy broadening out as global growth begins to accelerate.
We've seen a little bit of volatility over the last number of weeks with as a result of increasing of interest rates. Did you expect that volatility to continue and any impact of those increasing rates?
So the outlook is that the central banks continue to remain very accommodative. They are adding liquidity to the market, and real short rates still remain very low. We have a very solid fundamental backdrop. And so over the next 6 months, we think that is a very positive environment for risk assets. Real yields are expected to rise as term premium begins to increase. As we shift into the fourth quarter, when the net purchases of global central banks on QE begins to turn negative and liquidity contracts, that's when we think risks may be more susceptible to volatility than corrections.
So what does that mean in terms of favoured asset classes and sort of positioning of portfolios for the next 12 months and your view from a international asset class, particularly long overweight US market?
Sure. So we focus on the fixed income markets here, and my role is on the U.S. rates side. In general, though, we remain very positive on risk assets, again, particularly over the next 6 months. As we get into the fourth quarter, we think risk assets will have to balance between a very strong fundamental backdrop and adjust to a withdrawal of some liquidity at the margin. Again, this fundamental backdrop, though, does remain very strong and supportive of risk.
We've seen a very interesting political environment over the last 18 months or so. What's the general feeling on the ground here in New York as a result of that position?
Sure. I think we've been encouraged by the fact that two initiatives were able to be put through Congress on a bipartisan manner. I think, though, there are some concerns about the long-term sustainability of our fiscal deficits. It certainly benefited risk markets. I guess we are optimistic that both the Democrats and the Republicans can come together to push initiatives through, although we do remain somewhat skeptical that this bipartisanship will remain in place as we get closer to the midterm elections.
And a quick update on the fund you sit across as the portfolio manager.
The portfolio is positioned for a still positive risk backdrop, although we are cognizant that real yields are going to be moving higher, so we are positioned accordingly.
Well, Ed, thank you very much for your time. Really appreciate giving up your evening. It's about almost 6 o'clock here in New York. Mate, love to test you on your Australian knowledge. Maybe a favourite Australian movie, and maybe a line from that Australian movie.
Well, I did grow up watching Paul Hogan, so that's not a knife. This is a knife.
Yeah, fantastic. Thank you very much.
Thank you.
So it was a busy month. Again, we've rebounded back reasonably well in the last couple of weeks, but perhaps starting to get a little bit more cautious in the coming couple of months.